Okay, this video is for Unit 4, Activity 2, transaction number 6. All right, and this transaction number 6 has to do with a new style of adjustment. This one is the straight line amortization or straight line depreciation. And so this deals with when a company or a business buys some equipment or buys something that the value of it decreases over time. A car, a truck, computer systems, all sorts of things like that. All right, and so the reason that we make adjustments like this is that when you first buy the piece of equipment, let's take, for example, the example they use in transaction number 6, machinery. So when you first buy machinery, its value is whatever you paid for it. And then as you go along, it loses its value. And so this method of adjustment, the straight line adjustment, just figures out how much that machinery or whatever it is depreciates or amortizes. Those are synonyms over the course of its life. And the reason we do this is we don't want to be taken surprise when the thing is finished or when it's done or when it's no longer operational or when we have to buy new stuff. So we want to be aware of how much value we're losing on this item since we're keeping it on the books and we're keeping track of how much its value is to the business. And also when it's done, the business knows, when it's time to buy a new one. And maybe in the meantime, they've been saving up for a new one based on the amount that it's depreciated each month, something like that. So that's the reasoning for doing this kind of adjustment. All right, so let's look at our example. Number 6, machinery purchased January 1st, 2015 was $49,000 and is expected to last for 40 years and would be worth $1,000 at that time. The company is using a straight line method of amortization. What is the entry for May 31st, 2015? All right. So the things that we want to focus on first are our values or our numbers. So the machinery was purchased for $49,000 and it's expected to last 40 years. And at the end of the 40 years, it's supposed to be worth about $1,000. All right, so if we're going to do the straight line amortization, the first thing that we want to address is that part about the $1,000. That is what's known as the salvage value. So the amount that an object or a piece of equipment or machinery or whatever, how much it's worth at the end of its lifetime. And so in this case, it's $1,000. So when we are calculating our amortization or our depreciation, we want to subtract that salvage value from the original value because we're going to be able to get that money back at the end of its life or sell it for that amount. So we don't want to include that in on the depreciation, if that makes sense. So in this example, we are going to subtract $1,000 from the original amount that we bought the machinery for, which is $49,000. So again, that is easy math, but we'll get out our calculator just to make sure we're getting it right. And so $49,000 minus 1,000, it's going to be $48,000. So that is the amount that this piece of machinery is going to depreciate or amortize over its lifespan. And so its lifespan is supposed to be 40 years. So to calculate how much this machinery is going to lose per year, all we have to do is divide that number of 48,000 by 40. So the original value by 40. So then this machinery is going to lose $1,200 in value every year that we have it. And so the only other calculation that we now have to do is for 1 month, right? Because we just want to make an entry for May 31st, 1 month So how much is it going to lose from April 31st to May 31st? That's what this journal entry is going to be, the one that we put in the journal below. So the way that we do that is then we just divide this yearly amortization total by 12 again, because there's 12 months in a year, and that'll give us how much this machinery is losing in value per month. So we're going to divide this by 12, and we're going to get $100. So this machinery over its 40-year lifespan is going to lose $100 in value every month. And then at the end of its life, it's going to be worth $1,000. All right, so the $100 is what we're concerned with as far as our journal entry. So we're going to go down to May 31st, and we will put in this journal entry. Again, as with the other transactions, I'm going to introduce a couple of accounts here that you are maybe not familiar with. So in this example, our debit is going to be amortization expense. And we're just going to have a colon there, and it's going to be machinery. You would have an amortization expense account for all sorts of things in your business. For, as I mentioned before, your computer system, maybe your truck, maybe your cars, whatever you own as a business that is losing money, throughout the years, and that you'll eventually have to replace. Right. So again, this is an expense account. So when we're adding to it, it is a debit. And in this case, we found out, or this adjustment is just for 1 month. And we found out that this piece of machinery loses $100 in value every month. So that is going to be the amount in our debit. And then we just have to do our credit, which is the accumulated amortization account, again, for machinery. So and I saw that in my last transaction, I forgot to indent my credit, which is my mistake. I hope you caught that in my last video. And then it looks like I also forgot to do the description. So if you watched the last video or you were waiting for that description, let me put it here. Sloppy, I know, my bad. So if you needed that, that's there. Okay, so this one, accumulated amortization machinery. Okay, so this one is another contra asset account. And I explained what a contra asset account was in the last video. But remember, it's an account or an asset account that the debits and credit work contrary or opposite to how debits and credits usually work in an asset account. And the accumulated amortization account would be linked to the other asset account for the object or the thing that you're amortizing. So in this case, we would have a machinery account in our assets, and then right below it, we'd have the accumulated amortization machinery account. Again, that's so it can kind of comment on the machinery and the value that we have listed for it. So our original value for the machinery in our balance sheet would be listed at $49,000. And underneath it, we'd have the accumulated amortization machinery account, so that you would know where you are in its life cycle. Maybe it's down to $46,800 in worth, so we've had it for, I don't know what that would be, a year or 2 years or something like that. But anyway, it gives the business owner or the accountant an idea of how far along we are in that machinery's lifespan and what its current value is. So that's why we make this adjustment. And so that's going to be a credit. Even though we are adding to this accumulated amortization account, which is an asset account, it's going to be a credit, which, as I said, goes contrary or opposite to what you do in normal asset accounts. Normally, when you're adding to an asset account, it's a debit. But since this is a contra, it's going to be a credit. And then I won't make the mistake this time. I will do my description of what's going on in this transaction. So I'm going to write this. To record amortization for the month, right? And we don't have to be more specific than that because the amounts are here. Amortization of what? That's already written there, so we are good to go. Right, so that is it for transaction number 6. Transactions 7 and 8 I will do together in one video. It is another style of amortization or depreciation. So rather than being straight line, it is a different kind of amortization known as declining balance. And so you just figure that out in a little bit different manner. And it's a different way of keeping track of amortization or depreciation. So more on that in the next video.